Imagine this for a second. A really charming local toy store is up for sale. You know the kind, just filled with wonder and nostalgia. For the right person, this could be an absolute dream come true. But, and this is a big but, when you're looking to buy a business, that dream can turn into a financial nightmare really fast if you don't look past the cute storefront and actually dig into the numbers. So let's dive in and see what the financials are really telling us.
All right, today we're all putting on our financial detective hats. We're going to analyze the real financial statements for a business we're calling WonderWorld Toy Emporium. Our mission? Uncover the truth hiding in the numbers and figure out if this opportunity is as golden as it looks on the surface. This is exactly how you learn to spot those crucial warning signs before it's too late.
So, let's say you're seriously thinking about buying this toy store. Where do you even begin your investigation? Well, for any business, the story always starts the top line. Revenue.
That's right, revenue. We're talking total sales. You can think of it as the lifeblood of the company. Before we look at literally anything else, we have to answer one really simple question. Is money still coming in the door? Let's see what the data has to say.
Okay, so this chart tells a 3-year story. In 2021, sales were around $350,000. Then you see this little bump in 2022, which, looks pretty promising. But then, whoa, look at 2023. Sales don't just dip a little, they completely fall off a cliff.
A 14% drop in a single year. That is a massive flashing red light. A small dip, maybe you could explain that away. But a drop this big, it demands a really serious explanation. This is our first major clue that something is wrong here.
Okay, so less money's coming in. That's bad, no question. But it's only half the story. To really understand if the business is making any money, we need to look at what it's spending. And this is where our investigation really goes a level deeper.
Just think about it in terms of your own budget. If your income goes down, what's the first thing you try to do? You cut your spending, right? A healthy business should be doing the exact same thing. So let's see if WonderWorld tightened its belt when sales started to tank.
And wow, this chart just shows you the core problem perfectly. Between 2022 and 2023, revenue fell by over $48,000. At the same time, expenses went up by over $43,000. I mean, this is the exact opposite of what you want to see.
This huge split, making way less money while spending way more, is just a recipe for disaster. It really shows that the business isn't adapting to its new reality. It's just burning through cash at a pretty alarming rate.
And here is the result of all that. Just look at how fast the net losses are growing. In 2021, it lost about $500. Okay, not great, but maybe manageable. By 2022, that loss balloons to over $6,000. And then in 2023, a staggering $54,000 loss. This isn't some slow decline, this is a complete nosedive.
So far, we've been looking at the company's performance year over year, but now we need to ask an even more fundamental question. What is this business actually worth? To find that out, we have to pull out the balance sheet.
Now, to figure out a company's net worth, you need to know this one key term, shareholders' equity. And it's actually pretty simple. You just take everything the company owns, that's its assets, and you subtract everything it owes, those are its liabilities. Whatever is left over, that's what the business is truly worth.
Okay, let's run the numbers for WonderWorld from their 2023 balance sheet. Assets, about $308,000. But then look at the liabilities, over $372,000. So when you do the math, the shareholders' equity is negative $64,000.
And this is the bombshell. A negative net worth means the company is technically insolvent. It owes more money than the total value of everything it owns. Think about that. If it sold all of its toys, all its shelves, and emptied its bank account, it still couldn't pay off all its debts.
So this should make you stop and ask a really critical question. How is a company that's losing this much money and is technically worth less than zero even keeping the lights on? There has to be a hidden source of cash somewhere. And there it is, buried deep in the notes of the financial statements. This one little sentence reveals everything. The company is being propped up by a massive loan from the current owner. And get this, the terms are incredibly loose. No interest, no collateral, and no repayment schedule.
And the size of this loan is just enormous, over $242,000. This isn't just a small cash injection to get through a tough month. This is a full-on life support system. For a new buyer, this is a gigantic risk. I mean, what happens if you buy the business and the old owner suddenly decides they want their $250,000 back?
Okay, so the past performance is terrible, and the company's financial structure right now is incredibly fragile. But maybe there's some hope for the future, right? Let's take a look at what's coming down the pipeline.
First thing we see is a guaranteed cost increase. The store's lease agreement locks them into a rent hike in 2025. For a company that is already losing tens of thousands of dollars, every single extra dollar of guaranteed expense is basically another nail in the coffin.
And this brings us to what might be the biggest disconnect of all. On one hand, you have the cold, hard reality. Sales just fell by 14%. But on the other hand, the current owner is projecting that sales will rebound and actually grow. Based on everything we've just seen, does that projection seem even remotely realistic to you?
Okay, our investigation is officially complete. We've followed the money from the top line all the way down to the very foundation of the business. So it's time to lay out all the evidence and come to a conclusion. So let's just quickly recap all the red flags we've uncovered. Sales are falling, and fast. Costs are somehow rising even faster. The company is losing more and more money every single year. It's technically insolvent with a negative net worth. And the only reason it's still around is because of a huge informal loan from the owner. On top of all that, its future includes guaranteed cost increases. At the end of the day, that romantic idea of owning this charming toy store just crashes head-on into a brutal financial reality. This isn't just a healthy business having a bad year. The documents show a company with really severe systemic problems that would be incredibly difficult for any new owner to fix.
So, we'll leave you with this final thought. If you were sitting across the table from the current owner, with all this evidence in your hands, what is the one question you would absolutely need to have answered? Thinking through that might just be the most valuable takeaway of all.